Should you fear a recession when the yield curve inverts? Imagine looking at a graph and seeing short-term interest rates higher than long-term rates. That's what we call an inverted yield curve. It's a signal that has caught the attention of many investors. Usually, longer-term bonds pay more because they carry more risk over time. When that pattern flips, it can seem like trouble is brewing. Historically, an inverted yield curve has often been followed by a recession within 6 to 18 months. Since the end of World War II, almost every time the curve inverted, a recession followed. That's why many people see it as a warning sign. The reason it works as a predictor is because investors expect the economy to slow down. They think central banks will cut interest rates in the future to stimulate growth. When investors expect lower rates, long-term bond yields drop. Sometimes, central banks raise short-term rates to tighten monetary policy, which can cause the inversion. But it's important to remember that the relationship isn't always perfect. Recent studies show that the predictive power of the yield curve might be weaker now. Low-term premiums, which are extra yields investors want for holding longer bonds, can make the curve look inverted even if a recession isn't coming. Technical factors like central bank policies or low inflation can also cause the inversion without an actual economic downturn. For passive income investors, it's wise not to panic just because the yield curve inverts. Recessions can lead to lower corporate profits and stock market drops, which might affect dividend income and the value of your investments. Bonds can be more stable during tough times, especially if you focus on high-quality bonds or those with shorter maturities. These shorter-term bonds are less sensitive to interest rate changes. To stay prepared, consider diversifying your fixed income holdings across different maturities and credit qualities. Building a bond ladder can help manage reinvestment risk and keep your income steady. Keep an eye on other economic indicators alongside the yield curve to get a clearer picture. Remember, recessions are usually temporary, and markets tend to recover over time. So, while an inverted yield curve has been a reliable warning in the past, it's not a guarantee of a recession. Use it as one of several signals to evaluate your investment strategy. Stay cautious but avoid making hasty decisions based solely on this indicator. Focus on your long-term goals and keep your portfolio balanced. This way, you can navigate economic changes without unnecessary worry.